Over $1 billion poured into water tech investment in 2024, a record-breaking year, and 2025 is on track to do at least as well. Sure, I've told you about that in the past, but here's what we maybe collectively overlooked so far. According to data I've patiently compiled over months and that I believe you'll find nowhere else, 86% of investors who touch water keep it at less than 10% of their portfolio. Let me make that worse. Among the 1,425 investors I've analyzed for today's deep dive, meaning all the ones that cut at least one water check over the past decade, the median water allocation is just 6.7%. And still, these are the believers. The other 96% of VCs worldwide have never touched water at all. But here's where it gets truly bizarre. There's a desert in the data. While 27% of water investors go all in as a specialist with over 50% exposure, and 73% treat it as a side bet with under 10%, virtually nobody, just 0.4% when you exclude thin data, sits in between. You're either a tourist or a specialist, never a resident. Now, today is a day where I really want to thank my sponsors, Simple Lab and Mentor APM, because this investigation alone cost me over $3,000 in various APIs, obviously on top of my time, and this would never be possible without their support, so check them out in the description and let's get talking about how I've discovered something that should fundamentally change how you think about raising capital in water. The math proves that water de-risks portfolios but caps upside at 3x, meaning that your water startup is not failing to attract a moonshot capital because you're bad at pitching. It's because the investors cutting checks in water were actually never hunting for a moonshot in the first place. Let me get you through my 6 top findings and then let's discuss what this implies right after I set the context with the following metaphor. Picture this, you're about to bet on who wins Wimbledon. Do you put your money on Nick Kyrgios or David Ferrer? And yes, I know David Ferrer just retired, but bear with me. Well, if you're hunting for a 100x return, the kind VCs dream about, you bet on Kyrgios. On his best day, he can beat anyone. He's beaten Nadal, Federer, and Djokovic. The upside is astronomical, but the downside is that he might lose to a nobody in the first round because he got into an argument with a fan.
Get me someone now!
Well, it actually happened. Said differently, you're taking your chance at a 100x at the expense of a possible 0. But if the bet is who makes it to the second week, suddenly Ferrer looks brilliant. He'll never win the tournament, but he'll also never lose to someone ranked beyond the ATP Top 100. He's your dearest bet for consistent, predictable, modest, maybe boring, but certainly reliable returns. Well, you guessed it, water tech is the David Ferrer of venture capital. And once you understand this, everything about water investments starts making sense, because in my last 2 deep dives on the topic, I obsessed over water specialists, the Burnt Island Ventures, Pure Terra Ventures, Eco River Capital, or Emerald Technology Ventures. These are the players living and breathing water, the ones who've built their entire thesis around the sector. And if that's of interest, I've got more podcast deep dives on exactly these guys in the pipe, so you know the drill. Make sure to subscribe. But here's what I missed so far. They are only 27% of the story. The other 73%, and that's 869 investors, treat water as something else entirely. And today, we're going to understand what that something else actually is, why it matters, and why it mathematically caps your startup's multiple potential. So enough context, let's follow the money through 1,425 investor portfolios and uncover the structural reality of water capital. And I already hinted at it, but let's start with this first finding, the side bet reality. For the sake of that section, I'll start by cutting through the noise and looking only at investors with at least 5 recorded investments, no matter where they cut those checks, as long as at least one is in water. Through that cleaning alone, which eliminates a lot of family offices that cut 1 or 2 checks to a single water company and call it an investment strategy, the median water allocation collapses to just 3.3%. 3.3%. Let that sink in. What that means is that even among investors who've consciously decided to put money into water topics, it represents roughly the same portfolio percentage as their coffee budget, I guess.
That's not much.
Jokes aside, the distribution tells an even starker story. 59.3% allocate 0 to 5% to water, 24.5% allocate 5 to 10% to water, 10.8% allocate 10 to 20% to water, and only 5.4% allocates more than 20% to water. So yes, we already knew that water specialists were the exception, but here we have it quantified. A water thesis is a very rare animal, roughly as rare as a French guy speaking understandable English.
Oh, that's very funny, very funny.
And still, all those tiny percentages came with a bias because we're only looking into investors who've actually done water deals. Because if we want a scare jump, we can zoom out to the full VC universe of, say, roughly 42,000 funds globally. In that zoomed out world, also called real world, I guess, your Series A is not just competing against other water startups for capital. It's competing against SaaS platforms, fintech apps, and AI tools that promise the kind of returns that make partners at the famous Sand Hill Road salivate.
But I like money,
So how's that work?
To use an analogy I've been using in my podcast episode with Uravu Labs, you're not fighting other rebel pilots for funding, you're a moisture farmer from Tatooine, trying to convince the Galactic Senate to fund your evaporator while the guy next to you is pitching Death Star technology. Essentially, you're bringing a moisture evaporator to a lightsaber fight. But enough geek analogies, let's look into my second finding that's a direct consequence of this first one. There's a donut hole desert. This one is straightforward. Nobody does water halfway. Look at the distribution curve and you'll see something that should hardly exist in efficient markets. A vast desert between 20% and 95% water allocation. Just 5.3% of professional investors sit in this range. It's like finding out that restaurants either serve water as a courtesy beverage on the side, or they're literally a water sommelier bar. Poke. Melon. Said differently, almost nobody makes water a real part of their menu. No water-forward cuisine, no water pairings, no mixed water wine list. And this is not random, it's structural. On the right side of the desert, you have the water specialists I've covered extensively before, the true believers who've built their entire thesis, team, and LP pitch around water. They understand pilot timelines, utility procurement cycles, and why a 3-year sales cycle for a membrane technology is actually pretty good. But on the left side, that's where things get interesting, because I believe that the 869 investors treating water as a side bet are certainly not doing it randomly. They fall into 3 distinct tribes, each with their own logic, check sizes, and portfolio construction strategy. To come back to my tennis analogy, they're not betting on water to win Wimbledon, they're betting on water to consistently make the 3rd round and collect a reliable price check that offsets their wild bet on that unknown Serbian teenager who might be the next Djokovic but probably isn't.
Wait, what do you mean?
If that's not clear enough, they're betting on water because when their AI moonshot loses in the first round, water will still be grinding out 3-set victories in the backcourt, earning enough to keep the fund alive.
I'm still not sure I understand it.
And if that's still not clear enough, let's clarify that with my finding number 3, the 3 tribes of water tourists. Here, and after clustering analysis of the 869 water as a side bet investors, 3 statistically distinct profiles emerged. I would think that those are not arbitrary groupings, they're different species of investor with fundamentally different theories about why water belongs in their portfolio. We first have type A, the digital finance generalist, with 328 investors in that group. Those are your option traders. These investors live and breathe enterprise tech, financial services, and fast-moving consumer goods, and their water allocation reaches a mighty median of 1.4%, basically a rounding error. The average check size is $625,000. They focus at 80% on early stage, so seed to pre-A, and their typical portfolio has 122 companies. Yes, You heard that one right.
Oh, that's that's a lot.
To be clear, here we're not talking of water investors with a digital kink that pushes them to do software. They are software investors who occasionally notice water exists when it looks enough like SaaS. They're not betting on water, they are learning, experimenting, maybe hoping to spot the next vertical SaaS unicorn that happens to sell to utilities. For them, your water startup is Nick Kyrgios on a bad day. Probably going to flame out, but hey, what if? As an anecdote here, I'm reading Overlooked, the excellent newsletter from Alexandre Devez for years, a newsletter where he shares how he's investing in seed and Series A European vertical solutions, which are industry-specific solutions aiming to become industry OS and combining dynamics from SaaS, marketplaces and fintechs. And in 203 releases, he's spoken of water twice. So it sounds like the maths are mathing here. And let me close that sidetrack by switching to my second profile, the type B, the Climate Industrial Build Complex with its 259 investors. Here, interestingly, we're talking about your David Ferrer investors. These funds focus on climate tech, industrial materials, and built environment. Their median water allocation of 5% is the highest among the three tribes, and I really believe it's not an accident. The average check size they cut is $2 million. Their stage focus is 2/3 early, 1/3 mid-stage, and their investor mix is 47% VC, 23% corporate VC, and some more outliers. If you want recent examples of what they do, they are the typical climate funds that backed Zwitterco or Gradient. And one clear thing these investors have in common is that they get CapEx. They understand pilot projects, they've seen the J-curves of other infrastructure plays. Water fits their worldview, it's industrial, it's essential, it's climate adjacent, and most importantly, it's de-risked. They don't need you to be Kyrgios, they're perfectly happy with Ferrer, making the quarterfinals every single time, collecting that steady 2 to 3x, balancing out the wild swings from their carbon capture bets. And that's a story for another day, but they would maybe invest in more water bets that fit that description if they found more or had a better understanding of the water market. But finally, we have our type C, the digital bio-industrial hybrids with a 282 investors cohort. Those are the scientists of the venture world, if you will. These investors split their time between enterprise tech, life science and industrial materials. Their 2.2% median water allocation sits between the other two tribes. They're interested, but cautious. Their average check size is $2 million. Their stage focus is 69% early, 27% mid-stage, and recent examples would be the deep funds backing Membrion or Aquacycle. They will bite on water when there's a genuine technical innovation, new membrane chemistry, novel biological treatment, breakthrough sensor technology, but it needs to smell like deep tech, not infrastructure. These investors are looking for David Ferrer again, but with a secret weapon, reliable enough to make the second week, but with just enough innovation to maybe possibly surprise everyone, because I'm bitching on that poor David Ferrer, but the guy still won 27 ATP tournaments. Interestingly though, for a clay specialist, he never won Monte Carlo. And talk of a transition here because, yeah, I'm a professional, but that's a smooth seg to my finding number 4, the portfolio insurance math. Why smooth? You ask, well, because that's the one where the tennis metaphor becomes mathematical reality. I had ChatGPT run 10,000 Monte Carlo simulations, see what I did here, of a typical 30-company VC portfolio comparing different water allocations, and I'm sure the results already exist in most water investors' laptops. Little preface here, the performance of investment funds overall, not limited to the ones touching water, is counterintuitively bad. If you never heard that stat, 92% of investment funds don't beat the market, meaning professional investors taking professional decisions out of their big professional brain do worse than stupid me putting $1 on a passive word ETF. So that context set, the stats actually show that a pure tech portfolio with 0% water has an expectation of a median fund return of 1.003x.
That's adorable.
That's a probability of losing money of 50%, and that's a probability of a 3x plus return of 15%. Now, if you take the historical behavior of water tech as depicted in the perpetually quoted on the channel work of Paul O'Callaghan in his book and eponym research, The dynamics of water innovation: water companies don't die and water companies don't scale. The two faces of the same coin, and talking of the past, not the present or the future. But let's take that and inject it in our Monte Carlo simulations with a 20% water allocation. Well, now our median fund return raises to a stellar 1.09x, with a lower probability of losing money, only 43%, but at the expense of a lower probability of a 3x plus return, with now only 12% chances. Let's then do it one more time, but this time with a 40% water allocation. Now you have a 1.2x median fund return. We start to be really talking here. The probability of losing money drops to 27%, but the probability of a 3x plus return also drops to a tiny 9%. Do you see what's happening?
No, tell me again, Captain!
Water dramatically reduces the chance of fund failure while modestly improving median returns, but it absolutely destroys the right tail. The chance of that fund making 10x outcome drops like a stone. And to keep with the software lingo, that's not a bug, it's a feature. Water acts as portfolio ballast. Your higher survival rate means you're unlikely to zero out. Your steady infrastructure-style returns means you'll probably return capital plus a bit, but your structural constraints, long sales cycle, capital intensity, regulated markets, mean you're almost never going to be the next Uber. Again, you're David Ferrer, getting to the second week of every Grand Slam, earning steady prize money, but never winning the trophy. But enough grinding that series of findings, there are more dimensions to explore in that dataset, and that continues in finding number 5, right after I tell you about today's sponsor, Simple Lab. Testing water and everything around it should be simple. With Simple Lab, you choose what to test, from drinking water and wastewater to soil, air, food, and surfaces, and they handle the rest. Kits arrive at your door with free round-trip shipping, samples go to certified labs, and results come back fast, concise, and actionable. Trusted by leading brands and growing teams, Simple Lab offers hundreds of ways to better understand your environment. Get started today at gosimplelab.com. It's the first link in the description. A big thanks to Simple Lab for supporting my work, and back to me with finding number 5, the check size revelation. Because if we slightly zoom out from early stage and as we move up the capital stack, something interesting yet logical happens. Water specialization increases. While VCs and their median check of $1.63 million have a 4% median water allocation, corporate VCs and their median check of $3.84 million have a 9% median water allocation. Growth funds and private equity with their median check of $6.5 million also have a 9% water allocation. And partly as an outlier, partly as the top of the pyramid, family offices with their all-around-the-place check sizes have a 33% water allocation. This has two main explanations. First, corporate VCs are more likely to invest around the field the corporate plays in, which happens in a similar fashion with PE platforms or growth stage theses. So yes, there is a strong bias in the dataset simply because we look into the ones that actually invest in water, and the groups here become much more exclusive and separated than in the early stages. But there's also a second explanation. The bigger the check, the more comfortable investors become with water's risk-return profile. Why? Because at growth stage, the technology risk is largely gone. You've proven the membrane works and you've got reference customers. Again, you're Ferrer in the quarterfinals. Boring, predictable, safe. Here, family offices are particularly interesting. They're the stealth water wells that fly under the radar. With 33% median water allocation, they are more water-focused than most funds that include water in their official thesis. And they don't need 10x. They need wealth preservation with upside. They need David Ferrer.
You keep repeating yourself.
But if all those allocation percentages are not 100%, this means that water has neighbors, right? That's what we'll explore in finding number 6, the adjacency map. And in fact, when portfolios tilt toward water, they also systematically tilt towards certain sectors and away from others. The correlation is quite strong, actually. Water has best friends with insurance and risk, a plus 0.77 correlation on a scale from +1 to -1, ocean and maritime with a 0.62 score, and more surprisingly maybe, defense and security with a 0.58 figure figure. Meanwhile, water has opposites with enterprise tech and its minus 0.6 figure, consumer and commerce with minus 0.45, and oh, the irony talking of investments, financial services with minus 0.37. I once more strongly believe this is not random. When investors increase their water allocation, they're building infrastructure portfolios, not moonshot portfolios. And pardon me if you're tired of the metaphor.
I'll say it once more, say it once more.
But they're collecting David Ferrers, not hunting for Nick Kyrgios. The typical water-adjacent portfolio looks like a utilities investment arm. Steady, essential, boring, profitable, kind of the antithesis of what makes partners at Sequoia or Andreessen Horowitz famous. Anecdotally, maybe, I noted a telling detail from analyzing the investor bios. 71% mention digital/AI/data, 62% mention impact or ESG, but only 10% mention regulation, compliance, and just 21% reference actual buyers or customers. Think about that, the two things that actually determine water tech success, regulatory drivers that force adoption and utility buyers with procurement budgets, barely appear in investor vocabulary. Instead, they're talking about AI and impact while writing checks to membrane companies and pump manufacturers. It's kind of cognitive dissonance at scale. They want to tell LPs they're funding world-changing innovation, Nick Kyrgios, in my tiresome analogy, but they're actually funding steady infrastructure plays, David Ferrer. They pitch their water investments using software language like scalable, disruptive, platform, and then they act surprised when a utility takes 3 years to approve a pilot. I believe that the investors who succeed in water are the ones who embrace what it actually is. Essential infrastructure with regulated buyers, predictable returns, and as a matter of fact, in today's paradigm, zero chances of becoming the next Facebook. And honestly, the ones who struggle are still trying to force water into a software venture narrative that it will never fit. You may ask yourself why that matters. Fair question. Thanks for asking.
Walter, have you been talking to yourself again?
Well, amidst the debates of whether there can be 10x or 100x in water, I wanted to highlight how water is not broken. It's playing a different game. The 869 investors treating water as a side bet are not confused or ignorant. They're rationally allocating capital based on water's actual return profile as it is historically and today. They use water to de-risk their portfolio, if they're type B, to learn about new markets, if they're type A, or to capture technical innovation with infrastructure characteristics, if they're type C. I believe none of them are hunting for 10x here. They're hunting for survival plus upside. I said it too many times, but I'll say it once more. They want Ferrer, not Kyrgios. But wait, it's maybe worth mentioning here that the co-founder of Water's only unicorn disagrees with everything I just said in that section. How do I know? Well, Prakash Govindan, who built Gradient into that $1 billion anomaly, commented on the latest release of my newsletter to share the following: I don't think being risk-conscious is the problem of the water industry investors combined. It is the opposite. Look at renewable energy space. Unicorns crash all the time. So what? Things move up leaps and bounds in the interim and other companies and unicorns succeed. In water, we sit in one place and nothing moves. So if I had $1 billion to invest, I would pick 100 bets like Gradient/Cranberry and give it to 100 different water entrepreneurs like Anurag, $10 million each before they have a business plan. No current investor wants to do that. That is a problem. It's a strong take, and it's hard to argue that many water plays were simply never given a chance to be anything else than a safe bet. So, is Prakash right? Should water investors throw out the Ferrer playbook and fund 100 moonshots at $10 million each? Would raising tide carries all boats actually work in water? Sure, the data I've just shown you suggests otherwise, but then again, Prakash built the only billion-dollar water tech company, and I'm just a water guy with spreadsheets, and I believe he's at least partially right, in the sense that we could be in a chicken and egg situation here. We don't see 10x's, so we don't invest like we would in potential 10x's, and in turn, we don't see 10x's. Nobody tried the Uber playbook on water because everybody is convinced it wouldn't work, but also because nobody ever tried. Could you take a couple of $1 billion, inject them in an aqua membranes, let them undermine the membrane spacer market until everybody has no choice but to adopt it, and then recover your investment through increased prices and enshittification? How would you know if nobody tries? That's a fascinating rabbit hole, and I give you that it's slightly off topic for today's analysis, but if you want me to dig deeper into whether water could actually support 100 unicorn attempts, let me know in the comments. We can even start the debate there. For now, let's get back to reality and round this off with the playbook all of this inspires. Until someone writes that $1 billion check Prakash imagines, here's how to navigate water capital as it actually exists. For founders, if you're raising from type A, so the digital finance generalists, lead with software, data, and automation, show rapid deployment potential, keep hardware minimal, target under $1 million rounds, and promise learning/option value, not returns. If you're raising from type B, so climate industrial builds, lead with pilot results and reference customers, show regulatory tailwinds and compliance drivers, embrace the infrastructure narrative, target $2 to $5 million rounds, and promise reliable 2 to 3x, not moonshots. And finally, if you're raising from type C, so digital/bio/industrial, lead with technical differentiation, show IP modes and scientific validation, connect to broader platform potential, target again $2 to $5 million rounds, and promise innovation with infrastructure characteristics. That's for founders, it's free, take it. Now for investors. Here, the math is clear. A 20 to 40% water allocation improves your fund's risk-adjusted returns. You're not sacrificing your moonshots, you're taking an insurance against them all crashing. If that's not yet hardwired in your brain by now, think of water as your Ferrer, consistently making quarterfinals while your Kyrgios bets either win Wimbledon or lose in round 1. For executives, understanding this landscape is crucial for corporate development. The investors backing your potential acquisition targets are not seeking 10x exits. They're seeking strategic buyers who'll pay infrastructure multiples for de-risked assets. You're not competing against IPO dreams, you're competing against other strategics who understand the value of consistency. Now, trust me, even after all these words, this analysis barely scratches the surface. These 1,425 investor profiles I've analyzed are just the emerged part of a massive data iceberg I'm assembling on Water Capital. You can already play with it for yourself using my free searchable database of all the water tech investors that cut 2 checks or more, their focus areas, check sizes, portfolio companies, contact information, and much more. Basically, straightforward data you can use to fund your company or peers you can scroll to determine if they are the right fit for your next investment roundtable. Check it out at investors.dww.show, investors.dww.show. The link is in the description. That's available off the shelf today, but that's only a taste of what's coming. If you register for free, you'll be signed up to be the first to know what's next, and it's happening soon. So don't miss out. Register on, I'll say it once again, investors.dww.show to stay in the loop when the full platform launches. And of course, subscribe here if you don't want to miss out on my next episodes. And if all this was of interest, you may want to have a look here to get 5 water tech investment facts that will blow your mind, because while you might never be Kyrgios with the right data, you can be the best damn Ferrer this industry has ever seen. Sometimes, making the quarterfinals every single time is exactly what the word needs, right? So see you next time.